Good evening to all of you. Welcome to our class. The last time we met, we were discussing on how to determine the cost of capital for a company. Okay, so that generally, when it comes to the determining or analyzing the cost of capital, then we ought to determine. Okay, well, there's some sort of equal steps. Okay, so we make sure that the first thing you need to get is to determine where the company finances is coming from. Okay, so get to know who are the capital providers of the company. Okay, that's first step. So get to know where the company finances are coming from. Who are the financiers? Who are the persons who have financed the company? The acquisitions, okay, of the company assets. Okay, that's what we did discuss. One of the few key steps that you may want to have. Okay, the next thing, of course, is determine the cost of funds. Okay, from each one of those capital providers. Okay, if the company has debt holders. Okay, so what the cost of the company for using or for obtaining that debt capital from those debt providers. Okay, if the company has used equity finance, okay, to finance its assets, to finance its projects, to finance its investments. Okay, next, therefore, determine what return do the equity shareholder therefore expect. Okay, and the same applies. So first determine where the money came from. Next, determine the cost of funds from each one of them. Okay, once you've done that, get the market weights. Okay, you determine therefore what is the market value of each of the capital source the company has used. Okay, get the market value of each of the capital source. Okay, and of course that's it. Determine therefore with the average cost of capital. Okay, based on the cost of your capital source as well as their weights. Okay, and you see that it's better that you use the market weights. It's better to use the market value because you do not want to underestimate. You do not want to underestimate the contribution of the cost of equity towards the entire company cost of capital. Okay, at the same time, you want to be reflecting the current status. Okay, if you have to use the book value, you'll be reflecting the book state of the company. When if it's about the cost of equity, okay, you'll be reflecting what was the book value, okay, at the time of issue, which could be maybe many years ago. Okay, so you prefer to use the market value, market weights, as opposed to use of the book weights. Okay, and that's what we were discussing the last time we met. Okay, that is in case I remember correctly. Okay, that's in discuss. We did an example. Okay, I think it was this example. Maybe just confirm from one of you that example we did. Sharon.
Yes.
This is the last thing we discussed the last time we met.
Yeah.
Okay, great. Okay. Now, okay, let's therefore attempt the question from your examiner. Okay, let's see how your examiner, okay, normally tests from this area. Okay, as I mentioned, the same step that I mentioned will be the one to be applied also when it comes to taking care of the exam question. Okay, getting to know. Okay, first get to know where the funds come from. Okay, then guess the cost of the return each provider of capital expect to receive. Okay, get the market weights and get weighted average cost of capital. Okay, now let's go through the question bank. Okay, we identify the. Okay, I suppose that you have gone through the question and you have understood what the examiner required of you. Okay, so here it means us to get the company weighted average cost of capital using the market weights. Okay, as I had mentioned to you, the first thing, of course, is to determine where the capital the company capital came from. Okay, who are the capital providers of the company? Of course, the best way to look at the company balance sheet. Okay, so here if there's equity, there's debenture, and there's preference shares. Okay, you don't need to write it down, but you want to note it. Okay, next step is to get the cost from each one of them. So begin this step number 2. Okay, can go to step number 2. Therefore, to get the cost of capital from each one of them. Okay, so let's begin by getting the cost of equity. Okay, cost of equity. Okay, don't forget when it comes to get the cost of equity, we said there's 2 models you can use. Okay, you can use the capital asset pricing model as well as you can use the dividend growth model. Okay, And as per the information given, I think you're going to be using the dividend growth model. Okay, you're going to be using the dividend growth model. It's the cost of equity, therefore, is equal to, okay, D naught 1 plus G divided by P naught plus G. Okay, so you need to get the D naught is the most recently paid dividend. Okay, as per note 4, the company pays 6% of its earnings as dividend. Okay, the growth in earnings is equal to 7%. So G, give it here, is 7%. P naught is the current market value per share, and to the current market value per share as per note 1 is equal to 50. Okay, so what we note here is together is D naught. Okay, so the company has an earning of $6. Okay, as per note 3, the earnings is 6 shillings. Okay, payout is 60. Therefore, the dividend paid therefore is 60% of the 6 shillings, which is therefore 3.6 shillings to be the dividend the company is paying. It's implied therefore based on this model. Okay. Therefore, cost of equity therefore will be equal to D naught is equal to 3.6, okay, times 1 plus G, 1.07, okay, divided by the current market value 50 plus the growth, which is equal to 0.07. To give therefore a cost of equity or not.
$0.147.
In percent?
14.7%.
14.7%, therefore the cost of equity for this company, 14.7%, okay. Next, the company has also obtained money from the debentures. So B, the cost of debentures. Cost of debenture is the next bit we need to discuss. And the debentures, okay, we need to know whether they are redeemable or they are irredeemable. As per note 2, the debentures are irredeemable and have a market value of 120. Okay, since they are irredeemable, the cost of debenture is given us the interest, okay, 1 minus t in case it's tax, okay. We do a current market value, okay, because we express that as a percent, okay. As per note 5 is tax, therefore the net interest income to be earned therefore is equal to the debenture pays at a rate of 10%, 10% of its nominal value, which is 100. We pay tax 30%, therefore the net cost to the company therefore is equal to 7 shillings per annum, okay, to infinity. Current market value as per note 2 is 120. The cost of the debenture therefore will be equal to the interest after tax, which is 7, divided by the market value, which is 120, and we express as a percent to give us
5.83.
Okay, 5.83, therefore the cost of this debenture, okay, the cost of the company 5.83%. Okay, the company also has obtained money from preference shares. So the next is to get the cost of preference shares. So C, cost of preference shares. So the cost of preference share is equal to the preferred dividend, okay, divided by the market value of the preference share. Of course, we express this as a percent. Therefore, preferred dividend. The dividend, as per the capital structure given there, it is paid at 12%. Therefore, 12% times the nominal value, and the nominal value is equal to 20. Okay. Therefore, the preferred dividend the company is paying to these preferred shareholders to be equal to 2.4 per annum. Okay. Now, these debentures, these preferred shares, they are also, we assume they are also irredeemable. Okay. The market value per preferred share, as per note 1, is 30. Therefore, the cost of preferred share is the dividend, which is 2.4. We do have market value, which is 30, Of course, we express this as a percent to give us how much?
8.
We get 8% with the cost of this preference share. Okay, that's step number 2. Getting the cost from each of the capital source. Okay, the debenture, ordinary shares, that is equity, and the 12%. Okay, preference shares. Okay, that's the second step. Step 3 is we get their market values. Okay, step number 3, we need to get the market value of those 3 finance capital sources. Okay, so step 3, we get the market values. Okay, can be the equity. Okay, in the case of equity, don't forget the total market value will be the number of shares. Okay, as per the extract of financial statement, the nominal value of the company equity shares is 30 million, and nominal value per share is 10. Therefore, we divide by 10. Okay, then you multiply that. This is therefore given the number of shares. Then multiply the market value per share, which is 50 as per note 1. And this is going to give us how much? 150. This is going to give us 150 million to be the total market value of the company equity, 150 million. Okay. Then you get the market value of debentures. As per the financial statement, the total nominal value of the debenture is 15 million. One debenture has a nominal value of 100, therefore divide by 100, and this is therefore is going to give us therefore the number of debentures issued. We multiply by the market value per debenture, which is equal to 120 as per note 2. Okay. Give us how much with the market value of the debentures?
$18
million. Get 18 million to be therefore to be the market value of the debentures. Next, we get the market value of preference shares. The market value of preference shares. The nominal value of preference share, okay, total nominal value is 5 million. Therefore, 5 million. We divide by the nominal value per preference share to give us 20. Therefore, this is going to give us therefore the number of preference shares issued. We multiply by the market value per preference share, which as per note 1 is 30. To give us how much? 7.5.
Yes.
Okay, and that's the 3 give us the total market value. 150 plus 18 plus 7.5 give us 172.5. Confirm.
It's true. It's correct.
That's 5.5 million for the total market value of the 3 company capital sources. The next step 4 is to get the average cost of capital. Okay, first is equity. We get the market value or the weight of equity, which is 150 million, divide by the total market value, 175.5 million. That's given for the weight of equity, 150 divided by 175.5. Then you multiply by the cost of equity. From our calculation, the cost of equity was 14.7 times 14.7. Okay, plus the weight of debenture, which is 18 million. Okay, divide by 175.5. Okay, so this is 18 million. Okay, 18 million times 18 million divided by 175.5 to give therefore the weight of debenture. We multiply by the cost of debenture, which we obtained to be equal to 5.83 times 5.83%. Okay, plus the weight of present share with 7.5 million divided by 175.5 times the cost of present share, which we got 8%. And that's therefore getting therefore weighted average cost of capital for the company, which is how much?
13.5.
13.5%, therefore the company with the average cost of capital. What that means is that for every dollar the company, for every shilling the company is going to obtain from equity, debentures, and the preference share, those three provide of capital extract 13.5 cents. Okay, that's what 13.5% mean. That for every one shilling the company obtained from the three combined, the equity, the debenture, preference share, the return that these providers need is 13.5 cents per year. Clear? Question? Okay, no question. That's a great thing. Okay. Okay, I suppose you have gone through the question. We got the required cost of equity, cost of debenture, cost of preference share, and weighted average cost of capital of the firm. Okay. So as I mentioned, don't forget the first thing is to get to know where the money came from. Okay, it came from equity, debenture, as well as from preference share, like the way you just done in the previous example. Okay, that's the first step, getting to know where the money came from. Okay, having done that, of course, the next step is to get to know, determine, okay, or to quantify, okay, the cost of capital. Okay, to quantify the cost of capital from each one of them. Okay. So let's determine the cost of equity. Okay, can get here cost of equity. Okay, two models you can use: dividend growth model, the capital asset pricing model. Okay, and as per if we're given note 3, note 2, note 4. Okay, they give us guidance that you're meant to use the dividend growth model cost of equity. D naught 1 plus G divided P naught plus G. Okay, we need to get the most recently paid dividend, and we told that the company, the company paid a dividend of 5 shillings in the just ended year. So D naught is equal to 5 shillings. The growth of the dividend, okay, we say is given us B times R. Okay, where B was the retention ratio, R was the return on equity. Okay, if you remember the use of the Gordon's approximation method. Okay, approximation method. This is therefore equal to B. The company pays, as per note 3, it pays 60. Therefore, they retain 40%. The return on equity, as per note 4, is 20%. Therefore, to give us a growth of 8%. Okay. Therefore, the growth in the dividend is equal to 8% based on the Gordon's approximation method, where G is equal to B times R. B is the retention ratio, and R is the return on equity. Okay. P naught is the current market value on X dividend basis. Note 1, the company share price is 45 come dividend. Now again, P naught is always on X basis. Therefore, we need to remove the dividend. 45. Okay, we subtract the dividend, which is 5 as per note 2. Therefore, the X dividend share price to be equal to 40. Therefore, we can get that for cost of equity. Therefore, is equal to D naught 5, the growth 8%. P naught is 40 plus the growth 8%. 8%, therefore, what's the cost of equity?
$21.5.
21.5%, therefore, the cost of equity, okay, 21.5. And if you don't assert something, don't forget, don't write down. Okay, it's better that you write down something that you know. Okay, and so in case there's any question, don't hesitate to ask. Okay, but
Excuse me?
Yes, sure.
Excuse me, sir. I'm wondering where you got the proportion of profits that are retained. B.
Okay. In note 3, what's the proportion being paid out?
Note 3. The firm adopts a 60% dividend payout ratio.
Okay. So they pay 60, they retain?
40.
Yes, 40.
Okay.
Okay. Any other question? Okay, that'll give us the cost of equity, which is equal to 21.5%. Next, the company also has the debenture. So this was the cost of equity to cost of debenture. okay, which will be equal to the debenture is equal to are they as per the capital structure given there, these debentures are redeemable. Therefore, the cost of the debenture therefore is equal to the interest on after tax basis if there's tax. We divide the current market value. Of course, we express this as a percent. The interest of tax, the net interest income. Okay, this deal is paid as it is paying the interest at 12%. Okay, 12% based on 8 par value. Okay. Now here, I don't know, we're going to do as per what the examiner is giving, though this question is very confused, because if you go to the through the capital structure, what's the par value based on the extracts of financial statement given there? What's the nominal value of this debenture capital, or these debentures?
20.
20. You can see 20 is not, it can be. Okay, anyway, we go as well they're giving us, because if you look at note 5, okay, if you look at note 5, okay, note 5, the market value is 112. So from 20 to 112, it does not make any sense at all. Okay, because it can only make sense that the company market nominal value ought to be 100, okay, as we always know, okay. But anyway, this is your examiner, so we go as what the examiner is giving us, because the financial statement given there, the power value given as per the capital structure, and note 5, they seem to contradict. But either way, that's what as what the examiner has given us. Therefore, times 20. You're paying tax. You're paying tax. Yes, you're paying tax as per note 7. You're paying tax. So net of tax. So net of tax, therefore, will be 30%, 0.3. Okay, the 20% is giving me the cost of the company. 0.7, so minus 0.3. To give us how much? $1.68. 1.68. Okay, 1.68. So you say that you just use what the examiner has given us, even though we know that that is seen to be a mistake anyway. So therefore, the cost of the debenture therefore is equal to. So first to be told that the come dividends, come interest. You look at note 5, the market value P naught. Let me just P naught is equal to, okay, the interest to be received, or the market value, okay, of this debenture, okay, on come interest basis is 112, but you need to remove the interest to be received. The anticipated interest to be received, which is after tax, is 1.68. The 1 minus 1.68, okay, which as you can see, zero to make a lot of sense anyway. So we get 112, 111.110.32.
Yes.
110.32, 110.32. Then the cost of this debenture therefore will be equal to the interest 1.68 divided by 110.32, and of course we express as a percent, a very low interest rate, but let's say a very low cost of the debentures, which is how much? 1 point.
$1.52.
1.52%, okay, to be the cost of this debenture. I say that this is very minimal. This is too low. Okay, it seems not to be legal, but anyway, let's just do it. Okay, that's how we get the cost of debenture. Okay, the next we get the cost of preference share. So 3, cost of preference share. We say that it's given us, okay, preferred dividend. We divide by current market value of those preference share, and of course we express as a percent. Okay, therefore preferred dividend for this particular bond is equal to it is paying the dividend at 14%, therefore 14% times its nominal value, which is equal to 25. Okay, what's the preferred dividend? What's the therefore the preferred dividend the company is paying to the holders?
$3.5.
3.5. Okay, 3.5 is for the preferred dividend. The market value of these preferred shares is as per note 6. Okay, you'll be told that the preference dividend occurs to 3.5 come dividend. Therefore, we need to get the ex dividend P note. Okay, the price is at 3.5 come dividend. Therefore, you do remove the dividend, which is equal to 3.5 to get the ex dividend market value, which is equal to therefore 30. Okay, therefore, cost preference share is equal to the dividend 3.5, the market value, which is 30, and of course we express this as a percent to give us
7.7.
7.7, and you get
11.
7.7.
11.7.
Oh, 11.7. Okay, thank you. You get 11.7 to be the cost of the preference shares. Okay, having done that, of course, what do you do? We need to you've done the cost from each one of the source of capital. We've done that. Next, to get the market weights. So the next step, therefore, is to get the market weights, market values. Okay, market value from each one of them. We begin the equity. We begin to get the market value of equity, which is the number of shares issued. The total nominal value of the shares of the company is 50 million. One share has a value of 20, therefore divide by 20 to get the number of shares. Then you multiply by the ex dividend price, which is equal to 40. Okay, that is the market value of the equity. Okay, then we get the market value of the debentures of the company, which is equal to the number of debentures issued, which is equal to 25 million nominal value, divided by the nominal value per debenture, which is 20. Okay, we multiply by the market value per debenture, which is 110.32. Okay, then get the same for the market value of preference shares. Okay, which is equal to, okay, the number of preference shares issued, total nominal value is 15 million, total nominal value. The preference share, the par value per share is 25, therefore divided by 25. Then we multiply by the market value per preference share, which is 30. Okay, to give us how much? Yeah, of course, we get the total here.
$255.9.
Okay, for equity, 255.9.
No, that's the total.
That's the total, okay.
Equity is 100 million.
100 million.
137.9. 18.
18. And you get 250.
5.9.
255.9, therefore the total market value of the company's shares, the company capital sources, the three of them. Okay, the company capital sources for the three of them. Okay. Now, how we know that? Okay, we need to get the company weighted average cost capital. So step 5, what's average cost capital is the weight of equity, which is 100 million, divided by the total market value, 255.9 million, times the cost of equity, which we obtained to be equal to cost of equity 21.5, which was 21.5. Okay, plus weight of debenture 137.9 million, divided by 255.9 times the cost of debenture, which we got to be equal to 1.52. Okay, plus the weight of preference share 18 million, divided by 255.9 times the cost of debenture of preference shares, which is equal to 11.7. And you get how much?
10%.
And you get exactly 10%.
10.04.
Okay, 10.04. Okay, 10%. Okay, you get 10%. Therefore, to be the cost of the preference shares, the cost of capital to the entire company. Okay. That's what I meant to do that question. There is a question, I guess. Okay. I think a bit this one is too easy. Let's see where they can get maybe a slightly complex one. Let's see if they can get one. Most of the questions that are here is just like what we've just done. Anyway, question May 2017, May 2017, May 2017. Question 1C. May 2017, question 1C. So go through it, we discuss together. Okay, so you're going to attempt to discuss it together. Essentially, that you have discussed, we have equity, debenture, preference shares. So, okay, got to read it together. It's the same thing the examiner is going to ask over and over again. Okay. Required the annual growth rate, dividend, cost of equity, cost of debenture, cost of preference share, and the cost of capital to the firm. Okay, so growth and dividend. We can use to model, okay, the use of the historical dividend, which is similar to get here. Or we're going to use the Gordon approximation method. We said G is going to be times R. Let's see, we can get the retention issue. As per note 2, the company paid 40, and they retained 60. The return on equity, the earnings of the company recently has been 5. The equity of the company, okay, as that was being 25. Therefore, okay, therefore, so B is equal to 60%. You pay 40, you retain 60. Okay, return on equity. Return on equity forget is given us net income. Okay, we divide by equity. Okay, divide by equity because we express this as a percent. So this is not given to us in this question. So you need to make a calculation. Okay, net income as per note 1, the earnings per share has been 5. Okay, therefore the income, total income is 5 times the number of shares, which is equal to 20 million. 20 million divided by 10, by 20. Okay, this gives for the total net total earnings of the company at that point in time. 5 million is earned per share. This is per share. The total net income, therefore, is 20 million. Okay, the total nominal value of equity shares we divide by 20. The value per share, the nominal value per share. Okay, we divide by the equity value. Equity is made of the two reserves, that is retained earnings. Okay, plus of course the ordinary share capital, which is therefore give us therefore a sum of 25 million, and we express this as a percent. Therefore, what's the term equity?
Sir, I've not understood what you've done. Please, can you repeat? Especially on net income.
Okay. If we do that here, the company has an earning per share of how much?
Earnings per share. 5.
5. Okay, the earning per share. Therefore, total earnings, okay, which is in the net income, okay, will be equal to the earning per share times the number of shares, isn't it?
Yes.
Okay. We go back to the company capital structure. What's the nominal value of the company equity share?
20.
20 million. What's the value per share?
The value or the value per share is 20.
20 divided by 20. This therefore is going to give us the number of shares. Okay, isn't it?
Yes.
We multiply by 5. That's give therefore total earnings or net income, isn't it?
Okay, yeah.
Okay, great. And you get how much? Therefore, the company return on equity. The return on equity, net income divided by equity. And equity, don't forget, is the reserves plus the ordinary share capital.
%20.
20% on the return on equity. Okay, so we have the B, we have the R, therefore. G, therefore, growth in equity in dividend is equal to the B, 60% times 20% the return on equity to give us 12% to be the annual growth in dividend, okay, based on the Gordon's approximation method, okay. So that's not one, not two, the cost of equity, okay, cost of equity, okay. Okay. This because equity gets given us, okay, D naught 1 plus G divided by P naught plus G. Okay, therefore gets D naught, the most recent paid dividend. So D naught, don't forget the company has an earning of 5. They pay 40, therefore times 40. Therefore, the amount they paid during that particular time period was equal to 2. Okay, because the earnings was 5, they paid 40, and therefore the amount they paid was 2. Okay, therefore we have P naught, the current naught 3, the current share price is 50, and you have the G. The of course therefore is D naught, which is 2. The growth is 12%, 1.12. P naught, the market value per share, which is equal to 50 plus G, which is equal to 12%. Therefore, this to give us how much? This will give us
16.48.
10.48%, therefore the cost of equity 10.48. Next, we must get the cost of the debenture capital. Okay, the cost of debenture. So 3, cost of debenture. Okay, cost of debenture. So here we do that. Okay, cost of debenture. So here we given out. We need to know whether it is redeemable or it is irredeemable. Okay, so there is a note on the debenture. Yeah, so note 4. The current debentures are trading at 110% of their par value, and the par value is 100, therefore they trade at 110. They're paying 10%. There's no comment regarding whether they are redeemable or they are irredeemable. So, of course, we go to the common assumption that these bonds are irredeemable, okay? Because if they are to be redeemable, then there must be, okay, an N, the number of years to redemption, which in this case we don't have, okay? Therefore, we may assume therefore these bonds are, these debentures are irredeemable. Therefore, we go to the interest over tax, 1 minus 3. Okay, we divide by the market value. Of course, we express the percent. The interest or tax. The debenture is paying at a rate of 10%. Is there tax? Yes, there's tax. We have 10% times the nominal value. Therefore, the cost of the company is 30%, is 70%. Therefore, and therefore the interest to be paid. The interest expense of the company per year is therefore equal to $7, 7 shillings. Okay. Cost of the debenture therefore to be equal to the interest 7 divided by P naught, which will be told is equal to 110, and we express this as a percent. To give us how much?
6.36.
6.36% become therefore the cost of the debenture. Okay. Next, we get the cost of preference share. Okay, cost of preference shares. Given us the preferred dividend divided by market value of those preference shares and expressed as a percent. Okay, the preferred dividend therefore equal to as per note 5. Okay, they are paying the preferred the preference share dividends at a rate of 8%. 8% of the nominal value. The nominal value is 20. Left 20. Give therefore 16 or 1.6. 1.6, I guess. 1.6 to be the preferred dividend. P naught, the market value, is as per note 5 is 25. The cost of preference share is the dividend 1.6 divided by P naught. P naught is equal to 25, and we express this as a percent. To give us how much?
6.4.
And we get 6.4% to be the cost of this preference share. 6.4 to be the cost of these preference shares. Okay. Next, we get the cost of weighted average cost of capital. Okay, which is equal to the market value of equity. We need to get the market values even before we get the cost. We need to get the market value. So market values. The next step is to get the market value from each of those three sort of finance, sort of capital. Equity. Okay, we need to get the number of shares, which is 20 million divided by 20. Therefore, this give us therefore the number of shares issued by the company. We multiply by the number by the market value per equity share, which is equal to 50 as per 3. 50 as per 3 give us 50 million, I guess. 50 million. Then again, the market value of the debenture, the market value of the firm's debenture, which should be told is equal to the nominal value is 10 million. The nominal value per debenture is 100, therefore divided by 100. We multiply by the market value per debenture, which is 110, to give us 11 million. Then get the market value of preference shares equals the number of preference shares issued. Okay, the total nominal value 15 million. Nominal value per preference share is equal to 20, therefore divided by 20. We multiply the market value per the preference share, which is 25 as per note 5. Give us how much?
18.75.
18.75 million, because therefore the nominal market value of the company preference shares. Total market value, therefore, 29.75.
Yes.
Okay. We have the market value and we have the cost. Therefore, now we can get with the average cost of capital. We begin the equity, market value 50. We multiply by its cost. First, we need to get the weight, 29.75 million. Okay, we multiply with the cost of equity, which from working, we got 16.48. Got 16.48 times 16.48% plus the debenture has a market value 11, therefore weight is 11 million divided by 79.5 times the cost of debenture, which we got to be equal to 6.36 times 6.36%. Okay, plus the weight of preference share, which is 18.75 million divided by 29.75 million times the cost of preference shares. Okay, at a cost of 6.4%. Give us how much?
12.71.
12.71% therefore the company with the average cost of capital. Okay, 12.71. Now I want to share a question. Okay, it's beyond the question bank. I think could be good. Okay, so check on our WhatsApp platform. Question there, which I think could be good for us to do. Okay, yeah. Okay. Okay, so the question is from December 2010. Question 2 should be D, I guess, or 2C, I guess. 2C. Okay, so go through it, then we discuss together. And suppose you have gone through that question. So we ask you the company cost of capital, use the market or make the market weights. Okay. So this is the process that I normally do. Get to know where the money came from debt, from preference shares, from equity shares, then get the cost from each one of them. Okay. So you can begin by getting the cost of equity. Okay, I think that's easy. Get the cost of equity. Cost of equity. So this is December 2010. Question 2C. Okay, cost of equity. Okay, and based on the information given there, we have growth in dividends, we have equity beta. Okay, well, we can use all those. Okay, quite a confused one, but anyway, I think you can use either model because you can. Okay, let's use. Okay, I'm sure that you're going to get a different answer. Okay, because your examiner sometimes has quite weird way of setting questions. But anyway, let's use the first model. Let's do the dividend growth model. Because equity, therefore, D naught 1 plus G divided by P naught plus G. Therefore, the most is a paid dividend. The company has just paid 3.6, therefore D naught is equal to 3.6. The growth in the dividend will be told is equal to how much? 9%, 1.09. P naught, the current market value is 60 plus 0.09. Give us how much? Because of equity using the dividend growth model.
$15.54.
15.54%. Therefore, the cost of equity engages you to use the dividend growth model. Don't forget, based on the information given, you can also use the capital asset pricing model. Okay, basically the cost of equity is equal to risk-free equity beta, the return on the market portfolio minus the risk-free return. Risk-free, which is the yield on the treasury bill, okay, is equal to 11%. Equity beta for this stock is 1.51. Return on the market portfolio is equal to 14% minus risk-free 11%. Give us how much?
$15.53.
Okay, I'm quite surprised that they give the same answer. Okay, because in the past I've seen questions where they give different answers. Okay, both model. Okay, so which one to use, I don't have no idea. Okay, well, I think you might see some of these questions as you go through the question bank. Okay, where the two models give different answers. Okay, then for this example, at least it seems to be give you the same answer. Anyway, that's on the cost of equity, the cost of equity. Then you can also do the cost of preference share. You get the cost of preference share, cost of preference shares. Okay, and P will be equal to preferred dividend, dividend market value, and of course we express this as a percent. Okay, preferred dividend, okay, is equal to the preference share. They are paying dividend, okay, at 11 per share. Okay, 11 per share. Okay, so they don't need to do that working. Okay, so the cost of preference share is the dividend 11 market value being told is equal to is 100. However, if they are to be floated, that is, they are to be issued in the market, then the net amount to be received is going to be equal to 5. Therefore, you need to net off, okay, the flotation cost. So okay, here it will be equal to P naught minus, okay, this should be equal to P naught, okay, less flotation cost, okay, the net amount, okay, the value that can be seen for every issue of share, which is equal to 100 minus the cost, 100 minus 5, okay, and of course we express this as a percent. Give us how much?
$11.58.
11.58, okay. As just repeat here, don't forget here, what really matters is if the company was to issue these shares in the market, what is giving the amount per share they'll be receiving? It is P naught less the cost of issue, okay, which is the 5 shillings, okay. That's the cost of per share. Then this company also has the debentures, or has debt, okay. We told they have a market value of 92. Number of years to redemption is 10 years. Yeah, and that is it. Okay, fair enough. Therefore, we can get the cost of these bonds. These are bonds that are redeemable. Okay. If you know, it's the P naught, okay, the current market value is equal to the interest net tax, okay, 1 minus T, of course, times present value and factor. The number of years here is N years, okay, at percent, which is our discount rate, plus the redemption value, we discount back to a 0 from the 10th year. Okay, so first we need to get the net interest income to be earned, the net interest income, or the net interest expense of the company. It is paid at 12%, and the book value is 100. The book value is 100. The tax rate is that percent, so 1 minus 0.3, and this gives therefore 8.4. So therefore, for every bond, the net interest expense to the company is 8.4, or the net income to the holders is 8.4. No mention on redemption value, but of course we assume that redemption occurs at par value. Okay. So trial and error method, don't forget. Okay, we use trial and error method. Okay. What is 8.4 divided by the market value? How much is 92? 8.4 divided by 92, what do you get? What I mean here, okay, this is a working you don't need to do, okay? But you just want to know if this bond was to be irredeemable, what would be its cost? Okay, it would be equal to 8.4 divided by the market value 92, and we express a percent to give us
9.13.
9.1. Okay, this is a working that you don't need, but you want to refine your work to avoid many attempts. Okay, so your answer therefore should be not too far from 9.1%. Okay, so therefore I can begin at 9 because okay, as per given from that hint there. Okay, let's discount the cash flows at 9. So at 9%. At 9%, okay, we have therefore will be equal to negative market value 92 plus the interest received, which is 8.4 for the next 4 years, present value, and it factor 10 years 9%. This is our first trial. Okay, plus okay the present the market value, the present value of redemption value 100 times present value interest factor, 10 years 9%. If 9% is a cost of debt, then we want to get a sum of 0. Okay, but either let's see how much you get. How much do you get?
I'm getting 4.15.
Positive or negative?
Positive.
4.15.
Yes.
Sorry. Okay, 4.15. So therefore, we can increase our discount rate to, let's say, 10%. Okay, same process, but now at our second trial, 10%. Therefore, this will be equal to negative 92. Okay, plus 8.4 times present value current factor, 10 years, 10%. Plus we discount 100 back to year 0, present value interest factor, 10 years, 10%. You get how much? If you had to use 10% as our discount rate.
Negative 1.84.
Negative 1.84. Okay. And based on those two, therefore, we can conclude and say that the cost of this debt, okay, is between 9 and 10%. Okay. So let's use, therefore, the Irr formula. Cost of debt, therefore, to be 9% plus 1%, the difference between the two of them. The value at 9%, 4.15, 4.15 minus 1.84. Give us 9.
9.69.
9.69%, therefore, the cost of this debt. Okay, this is our second step to get into it to determine the cost of capital from each of the capital source. Okay, equity, preference shares, as well as debt. Having done that, next is to get the market weights. Okay, next working therefore is market weights. Okay. Market values. Okay. So equity can begin by getting the market weight of equity, which will be equal to the number of shares, the total nominal value of the shares of the company is 600 million. We divide by the nominal value per share, which is 100. We multiply by the market value per share, which is 60. Okay, I get the market value of equity. Then you get the market value of preferred stock. Okay, preference shares. Okay, which will be equal to the nominal value preference share, which is 150 million. We divide by the preference stock of value per share, 100. We multiply by the market value per preference share, which we've been told to be equal to, how much is this? New stock 100, which is equal to 100. Okay. Then go ahead. The market value of debt, nominal value of the debt of the company, as per the capital structure given there, it is 250 million. Divided by the preference, the par value per debenture, 100. We multiply by the market value, which is 110. Oh, no, sorry, 92. 92. So the market value is 92 for the case of debt. Okay. Equity market value, 3.6 billion. or 360 million. It should be 360 million. Confirm. I'm just guessing. Confirm those values.
Two thirty.
For that is 230. I lost you.
770.
Sorry, 230 point.
The
It's
total is
230.
770.
No, debt. What is the market value of debt? I'm not sure. I didn't get it correctly. What's the market value of debt?
230.
Exactly 230. Okay. Okay, 230 million. Total, therefore, is how much?
770.
770
I'm
million.
getting 740.
740.
Oh, 740. 740. Okay, 740. 740 million. Okay. You have the market value and you have the cost from each one of them. Therefore, we can therefore be able to get the weighted average cost of capital. Equity market value, 360 million, times the cost of equity, we got 15.54%. Market value of private share, 150 million. Cost of private share, okay, which as per the working, we got what? Cost of private shares, we got 11.58 times 11.58%. Plus cost of debt, market value of debt, 230 million. Cost of debt, we got 9.69. Of course, we do have market value from the three sources, 740 million, to give us how much?
$12.92.
12.92%, therefore the cost of capital to the company, 12.92%. You can see this is quite an easy process. Okay, I guess there's not much complication here. Okay, 12.92%. Any questions so far? Okay, no question. That's good. Now, sometimes you can have cases where the company want to estimate what would be the cost to the company if they were to obtain an extra funding, okay, from other provider of capital, okay. For instance, the company may have a project that is going to cost them, let's say, 10 million, okay. So you want to determine, okay, whoever is going to be financing the 10 million, whoever is going to give the company 10 million, be they be equity shareholder plus debt holders plus private shareholders, what return do they want for the 10 million they want to give to the company? Okay, don't forget the company currently has its own provider of capital, but now they want to obtain more capital. Okay, so the question therefore is, what is going to be the cost for every one sharing they're going to obtain from those provider of capital, for those new provider of capital? Okay, that's what we want now to discuss. What we call weighted marginal cost of capital. Okay, we call weighted marginal cost of capital. Weighted Marginal means maybe the extra increment, or maybe, okay, marginal, okay, cost of capital. As I mentioned, don't forget, this give me the, okay, let me just define it, okay. This is, okay, this is, okay, the extra cost, or the cost. This is the cost the company will incur. This is the cost the company will incur for every extra shilling, of capital, for every extra shilling of capital they intend to obtain. They intend to obtain from the market. They intend to obtain from the market. Okay, so what's given the share? For every, okay, it is the cost of every new sharing, raised. Okay, it is the cost of every new sharing that is going to be raised from the market. That's called the marginal cost of capital. Okay, the cost of every new sharing the company is going to be obtaining. Okay, from the market, from debt, okay, from present share. Okay, that's referred to therefore as the marginal cost of capital. Okay, as the marginal cost of capital. Clear? Okay, and the process is the same. Okay, determine where the money will come from, get the cost from each of the sources, get the market, get the weights. Okay, then get the company cost. Okay, so this is the process. So let me not go through the same step that we have already discussed together. Okay, so let me look for a question that's asking us to get a weighted marginal cost of capital. Okay, because sometimes the examiner they do ask from this area. Okay, yeah, it's exactly the same process. Okay, but in case you may not have done that question, then it might throw you off the balance. But not that there's anything straight. This question here. I hope you know. I don't think you have done this, but this is November 2017, question 3B. I don't think it's 3B. Okay, go through it, then we discuss together. November 2017, question 3B. Okay, I suppose you've gone through the question and maybe made some few attempts here and there. So you required the amount to be raised from equity capital if the capital structure remain unchanged, number of shares to be issued, and the company will the marginal cost of capital. So first we indicate the composition of the company capital structure, equity, debt, simply equity and debt. Okay, so the company capital structure currently we have equity to be equal to made of two ordinary share capital. Ordinary share capital is ordinary shares. Okay, which is equal to for 80 million. Okay, so for 80 million. Then you also have retained earnings, retained profit, part of equity, don't forget, which is equal to 96 million. Total give us 576 million. That's for equity. Then you have debt. Okay, debt, which is equal to 384 million. A total of 960. Now, don't forget we want to get the weight, okay, of the current capital structure. Equity, the weight of equity here is equal to 526 million out of 960. Okay, weight of equity or composition of the company. So let's put it here. Weight in the current capital structure of equity is equal to 526 million out of 960 million. In percent, what is the weight of equity in the company current capital structure?
%60.
60%, because the company is equal to the weight of equity, and of course the balance is the debt. Therefore, this is 60%, and this is 40%. So we assume that this composition, the 60-40, it doesn't change even if the company issues or obtain the extra finance. Okay. So the amount of capital the company require, the cost of the project is 180 million. The cost of the project is 180 million. Project cost is 180 million. The amount that must come from equity is 60%. Okay, there was 60% of 180 million to give us how much? $108 million. The amount of out of the 180 will come from equity, and of course the balance will come from debt. Okay, don't forget equity is made of two. Okay, just as you're seeing here, it's made of shares and retained earning. Okay, as per note 5, the amount the company will have to obtain from retained earning is 18 million. Okay, therefore the balance is from the issue shares. Okay, therefore say amount from issue shares, from shares issue will be the balance, which is 108 million minus the amount that came from debt from retained earning, which is 18 million as per note 5 minus 18 million, give therefore 90 million. Okay, that's as per note 1. Let's give the answer to note 1. Okay, note 2, the number of shares the company would have to issue to get the 90 million. Okay, we know the capital is 90 and the amount to be received. Note 2, new shares will be issued at 30 less 5. Therefore, the net cash per share issued per share, okay, is therefore the amount, which is 30 less the cost of rotation, which is 5, to give us 25. Okay, therefore the number of shares that need to be issued, number of shares to be issued to raise the 90 million will be equal to 90 million minus divided by the amount received per share, which is 25. Therefore, how many shares need to be issued?
$3.6.
3.6 million shares need to be issued in order to raise the 90 million required. Okay. What else? And that is it for that Roman 2. Roman 3, we need to get the cost of capital, the weighted marginal cost of capital. Okay. So we need to get, so don't forget here, the money is coming from 3 sources, okay, from 2 sources, okay, from equity and from debt. But from equity, there are 3 sources, from issue shares, 90, plus the retained earning, 18, and now from debt. Okay, so you need to get the cost of equity. Let's begin by getting the cost of equity. Okay, cost of equity, and we first begin by getting the cost of retained earning. Okay, cost of equity. One is to get the cost of retained earning. Don't forget retained earning is part of equity. Okay, retained earning, the 18 million which we have used, the company is going to use. So okay, cost of equity. We can use 2 models. So here the information given is the use of the dividend growth model, D naught 1 plus G. Okay, do a P naught plus G. Okay, plus G. Okay, therefore D naught, we have been told as per note 3, it's 5 shillings. Okay, The growth in dividend is 5%. P naught, the current market value of shares of the company, immediately is equal to 30. Okay. Okay, 30 less the issue cost. What's we taking? Yes, that's 30 less the issue cost of 5. Okay, plus the growth in dividend, which is 5%, to give us how much? With P naught minus flotation cost. Because in this case, there's no. Here, don't forget, retained earning, you're not floating them. No, your flotation is issued to the market. In the case of retained earning, you're not issuing anything to the market. Okay, there's no flotation cost. Sorry for that. There's no flotation cost here because this is retained earning. Okay, so you're not going to go to the market and issue your own previous profits. Okay, so there's no flotation cost. Okay, anyway, what do you get?
$22.5.
22.5%. Okay, the cost of using retained earning. Then 2, cost of issuing shares. Okay, cost of shares. Okay, the same process. Okay, D naught 1 plus G, but this time around we are issuing them to the market. Therefore, there will be an issue cost. There will P naught minus flotation cost. Okay, plus G. Okay, because these are shares which they need to be issued in the market, and in the process there's some cost the company is incurring. Therefore, it will be equal to 5 times 1.05 divided by 30 minus 5, okay, plus 0.05 to give us how much? With the cost of equity for the issue shares. Sorry, 20?
26%.
26%. Okay, therefore get 26% with the cost of issuing new shares in the market. Okay. The next capital source is the debt. Okay, so I can say cost of debt. Okay, cost of debt. And the debt the company will be issuing, the firm are not one. The firm will issue 15% debenture at 120, cost 110, and each debenture is 100. No more mention about the debenture. So we assume these debentures are irredeemable. Okay, their first is to get the interest. Is there tax? Yes, there's tax as 106. The interest is therefore 15% of the nominal value, and the nominal value is 100. Okay, 100. We need to less the tax 30% to give us 10.5. Okay, they give us for the interest expense on after-tax basis. Therefore, cost of the debenture of this debt is equal to the interest on after-tax divided by the market value P naught, and we express this as a percent. This is if we go 10.5 divided by P naught. P naught is, okay, this is, it will be issued in the market. So there's an issue cost, okay, which you mean is equal to 10 per share, per bond. Therefore, it's 120 minus 10, okay, and we express as a percent. Okay, if there's an issue cost, you have to take it into account. You must take it into account the same way you've done in the case of the equity shares, okay. But for the retained earnings, you're not issuing them in the market, so there's no any issue cost, okay, because this is your own past earnings. Can you get how much?
9.5.
9.5% on the cost of this debt. And you're done. Because the money came from three sources, okay, from issue shares, from retained earning, and from debt. Okay. Therefore, weighted marginal cost of capital, okay, out of the 180, look, the total money is 180. 190 million came from shares, okay, at a cost of 26. 18 million came from retained earning at a cost of 22.5. Yeah, 22.5. The balance, which is how much? What is the balance, by the way? You need to know the balance. Here's this. Anyway, I think here you can do debt, which is the balance here, it's 180 million times 40% with the balance, which is how much? Which is 180 minus, which is 22 actually, because it's 180 minus 108, it's 22 million. So therefore 22 million come from debt, therefore 22 million times the cost of debt, which is 9.5, divided by total amount the company need to raise, which is 180 million. Then we want to get the cost per sharing, so we divide therefore by 180. And you get how much?
%19.
Okay, 19%. I will count therefore the cost of equity. For every one share the company is going to obtain from, for every share of the 180, the cost of the company is 19 cents. Okay. Clear question? Okay, no question. That is good if you did understand it. Next question we're going to do, we have November 2015, question 4A. Okay, go through it, we discuss together. Okay, so this seems to be a simple question. Okay, where the company want to raise money and they're going to raise as follow from debenture, from equity, and from the long-term debt. Okay, so we need to get the cost from each one of them. So let's begin by getting the cost of the debenture. So cost of debenture. The cost of the debenture, the company want to raise 100 million through a debenture issue. Each debenture will have a face value of 1,000 and an issue cost of 2%, a discount of 60. The coupon is 10%, and number of years to redemption is 10 years. So the interest of tax, okay, be equal to, it is paying at 10% per annum based on its face value of 1,000. There's a tax to be paid of that percent. Therefore, the net interest expense the company therefore is equal to 70 shillings. Okay. The issue cost, okay. We told that it's going to have a discount, so to have a face value of 1,000, issue cost of 2%, and a discount, it is going to be issued at a discount of 60. Okay, therefore, that's the P naught, the current trading value. Okay, therefore, it will be 1,000 minus the discount, which is 60. Okay, the discount is 60. Therefore, its market value equal to 940. Okay, that's therefore the current market value of this debenture. Okay. It will also have a flotation cost of 2%, okay, of course, okay, 2%, 940, then initial cost of flotation cost, okay. So P naught less flotation cost, P naught less flotation cost will be equal to 940, okay, minus flotation cost, which is 2% cost of the issue price or the face value, okay. I suppose they mean 2% on the face value of 1,000, okay, times 1,000. To give us therefore 920, confirm. $920, okay. Therefore, that's therefore what should be the amount received net of the issue cost, okay. Then fair enough, we can go now to work backward. Number of years redemption is equal to 10 years, okay. Therefore, we can say P naught, the amount received net of cost of flotation is 920. Therefore, 920 is equal to the interest to be earned 70 times present value and factor, okay, 10 years R% plus the final year redemption of the at par value 1,000 present value interest factor 10 years R%. Okay. 70 divided by 920, what do you get? 70 divided by 920, what do we get?
0.076.
So 7.6%.
Yes.
Okay, 7.6%. So we can begin at 8%, therefore. Okay, so let's begin discounting at 8%. Okay, at 8%. Okay, it will be equal to negative 920. Okay, plus 70 times present value unit factor, 10 years. Okay, 8% plus 1,000 times present value interest factor, 10 years, 8%. What do you get with the sum?
$12.91.
2.91.
12
12. Positive, negative?
positive.
Okay, 12.9%. Positive. Okay, let's try at 10%. Okay, this is just a trial. Okay, don't forget, this is a trial and error method. Okay, at 10%, to be equal to, okay, 9%. Let's try 9. I'm going to go a bit further. Let's just try 9, which is closer to 8%. You have 9 in your tables? Do you have 9% in your tables?
No.
Oh, you don't have 9% in your tables? Okay, let's do the 10. If we don't have 9% in the tables, let's use 10% therefore. Therefore, 920 plus 70 present value factor, 10 years, 10%, 1,000 times present value interest factor, 10 plus 10 years, 10%. To give us
I'm getting negative 104.
So negative 104. Okay. So with the cost of this bond is between 8 and 10%. Okay, which will be equal to, we can use therefore the IRR formula. Okay, the cost of the bond will be equal to 8% plus 2%, the difference between 10 and 8. The value at 8%, 12.91, divided by 12.91 minus 104 to give us 8 point.
$8.22.
8.22%, therefore the cost of this bond. What else? We have equity. So next we get the cost of equity. Cost of equity. Okay. The firm will raise 100 million through the share capital, the current level dividend. Therefore, we need to get the cost of, since there's mention of the dividend, we can use therefore the dividend growth model. Okay. The dividend is equal to 5. Okay. The growth is 10%. Current market price is 40. Flotation cost is 5%. The flotation cost, therefore, is 5% times the market value, which is 40, which is how much? 5 and 3%. 2. This is to be give us 2. Yes, give us 2. Okay. Therefore, cost of equity for this company with the dividend, which is equal to 5 cents times the growth, which is 10%. Market value, okay, 38, or rather 40 minus 2. Okay, 40 minus 2 plus the growth of the dividend, which is 10%. To give us how much? With the cost of equity in percentage.
$24.5.
4.5%, therefore the cost of equity. Okay, we're done with that. Then cost of debt. Okay, because this seems to be more of a loan, cost of loan. Okay, the common price 20 million. Okay, where they pay a debt at par value. Okay, this is not actually a loan. Okay, it's a loan. Let me call it a bond actually. A loan notes. Where they pay a net of 10% per annum. Okay, no mention whether it's redeemable. So we assume that this bond is irredeemable. Therefore, market value, it is being issued at par value. So therefore, the cost of this will be equal to the interest after tax divided by P naught. Okay, we express the percent. Okay, the interest we received after tax, therefore, will be equal to it is paid at 10%. So of 10%. Par value. Okay, they won't measure the par value. Okay, we assume it's 100 because there's no mention on the par value at par. Okay, 100. This is an assumption of bias made. Okay, 100 net of the tax together, therefore 70. Okay, P naught is the issue price is simply the P naught, which therefore is the par value. Therefore, the cost of the bond, therefore 70 divided by P naught 100. We extract the percent to give it therefore. This is not 70. Sorry, this is 7, not 70. Okay. Okay, together for 7%. Okay. we're done the cost from each one of them. Therefore, we can now be able to get weighted average marginal cost of capital. The money came from the company is going to raise 100 million, okay, from the debenture at a cost of debenture. Got what? Here it is, 8.22%. 8.22% is going to raise 100 million from equity at a cost of 24.5 to raise 20 million from this debt to be told here at a cost of 10%. We do the total amount they're going to raise, which is therefore to 20 million, which is 100 plus 100 plus 20. Therefore, was the marginal cost of capital of the firm?
$15.5.
15.
15.5.
15.5% therefore the marginal cost of capital for the company. Okay, that is for every dollar, for every sharing of the 220, they'll have to pay 15.5 cents to those capital providers. Clear? Question? Okay, no question. Great that you did understand and understood the question well. Okay, and fair enough. We meet on that on Wednesday. Okay, we start on valuation of company and financial instruments. Okay, let's see you on Wednesday.